What you see today is a culmination of a very carefully thought through and deliberately executed strategy. Over the years, we put together the building blocks, from maintaining offshore platform topsides, designing and building specialized offshore construction vessels, expanding our fleet of drilling rigs, to owning and operating our own oil and gas fields. Today, we're a Malaysian company offering solutions and services to the oil and gas industry across the globe.
The type of merger. The merger between Sapurakencana Petroleum Berhad and Kencana Petroleum Berhad is known as a horizontal merger. This is because both companies operated in the same industry, which is the oil and gas services industry. Before the merger, Sapurakencana Petroleum was strong in offshore, pipeline installation and subsea engineering, while Kencana Petroleum was well known for offshore fabrication and platform construction. Although their specializations were different, they were still operating within the same oil and gas sector. By merging, both companies combined their strength and expertise. This allowed the new company to provide complete and integrated services from engineering and construction to installation and maintenance. As a result, the merger improved efficiency and strengthened the company's overall capabilities in the oil and gas industry. Next, the main reason for the merger. One of the key reasons for this merger was to create operational synergy. By combining resources, technology, and skilled workers, the company could reduce overlapping activities and operate more efficiently. Another important reason was to achieve a stronger market position. After the merger, the company became larger and more competitive, which helped it secure bigger projects and gain more trust from international clients. The merger also helped the company achieve economies of scale. With a larger size, the company could reduce costs, use its assets more effectively, and improve profitability. Finally, the merger increased the company's global competitiveness. It allowed the company to compete with large international oil and gas service providers and handle more complex offshore projects, ensuring long-term growth and sustainability.
Data show that Kencana Petroleum current ratio fluctuated prior to the merge, recording 1.6086 in 2009, 1.4471 in 2010, and 1.4381 in 2011. In comparison, Sapurakencana Petroleum reported lower and fluctuating current ratio of 1.3535 in 2009, 1.4206 in 2010, and 1.2326 in 2011. Overall, Kencana Petroleum demonstrated a stronger ability to meet short-term obligations than Sapurakencana Petroleum before the merge. Following the merge in 2012, Sapurakencana current ratio increased to 1.0193 but declined slightly to 0.9924 in 2013 due to liquidity tightening during the restructuring process. However, the ratio improved steadily thereafter, reaching 1.2833 in 2015, indicating improved liquidity management. These results suggest that the merger and acquisition positively enhanced cash flow management, operational synergy, and the efficient use of current assets, ultimately strengthening the company's short-term financial position. Charts show that prior to the merger and acquisition, Kencana Petroleum quick ratio were 1.5176 in 2009, 1.3873 in 2010, and 1.4014 in 2011, indicating some fluctuation but remaining consistently above 1. In contrast, Sapurakencana Petoleum recorded much lower quick ratio of 0.3484 in 2009, 0.6087 in 2010, 0.4392 in 2011, with an increase in 2010 followed by a decline in 2011. Overall, Kencana Petoleum outperformed Sapurakencana Petoleum as Sapurakencana's quick ratio remained below 1 for all 3 years, while Kencana ratio consistently exceeded 1, demonstrating Kencana's stronger ability to meet short-term obligation without relying on inventory. After the merge, Sapurakencana quick ratio remained below 1 from 2012 to 2015, declining from 0.3590 to 0.3277. This indicates that the company faced difficulty in liquidating its current asset to settle short-term liabilities without using inventory. Consequently, the findings suggest that the merge and acquisition had a negative impact on the company's liquidity, as reflected by persistently low quick ratio.
Gross profit margin. Kencana Petroleum's GPM increased from 18.25% in 2009 to 24.77% in 2011, remaining higher than Sapurakencana's GPM, which rose modestly from 15.37% to 17.63% over the same period. This indicates that Kencana was more efficient in managing production and operating costs. After the M&A, GPM rose sharply to 30.10% in 2012 before declining to 22.20% in 2013. However, it recovered and increased again to 28.48% by 2015. Consequently, it demonstrates that M&A has a favorable effect on the company when they are able to increase their pricing power and efficiently control their cost. Return on asset. Before the M&A, Kencana Petroleum's ROA showed a declining trend, falling from 12.51% in 2009 to 6.76% in 2011. While Sapurakencana recorded an improvement from 7.07% to 10.29% over the same period. This indicates that Sapurakencana was more efficient in generating returns from its assets. After the M&A, ROA rose to 10.57% in 2012, but declined steadily to around 4.15% by 2015. Thus, it demonstrates that M&A has negative impacts on the company. Therefore, their inability to make a profit from their assets suggests that they are managing their assets inefficiently as a result of overinvestment or underperformance. Return on equity. The graph indicates that Kencana Petroleum's ROE declined from 27.56% in 2009 to 12.70% in 2011, while Sapurakencana Petroleum recorded an upward trend, increasing from 8.75% to 16.28% over the same period. This suggests that Sapurakencana was more efficient in generating returns from shareholders' equity. After the M&A in 2012, ROE rose to 17.33%, indicating a positive initial impact from equity consolidation. However, ROE declined steadily from 2013 to 2015, suggesting that M&A had an overall negative impact on the company's ability to maximize shareholders' return.
So, I will focus on activity ratios, which is inventory turnover, fixed asset turnover, and also total asset turnover. Each ratio provides important insight into how efficiently the company operates and how financially risky it is. By comparing the ratios before and after the merger, we can clearly evaluate the impact of the merger on the company's overall performance. Then, let me begin with the inventory turnover ratio, which measures how efficiently a company converts its inventory into sales. Before the merger, both companies showed a very strong inventory turnover performance. Kencana Petroleum recorded turnover between 31 and 45 times, while Sapurakencana Petroleum performed even better, reaching as high as 58 times. These figures indicate efficient inventory management, strong demand, and smooth project execution. However, after the merger, the inventory turnover of Sapurakencana Petroleum declined significantly from about 22 times in 2012 to just 11 times in 2015. This means the inventory was moving much more slowly than before. This sharp decline suggests that the mergers negatively affected inventory efficiency. Instead of achieving operational synergies, the company faced integration challenges and increased complexity, which reduced its ability to manage inventory effectively. Next, I will discuss the fixed asset turnover, which shows how effectively the company used its fixed assets, such as equipment, vessels, machinery, to generate revenue. Before the merger, Sapurakencana Petroleum demonstrated relatively stable and efficient use of fixed assets with ratio above 3 times. Kencana Petroleum, however, showed a sharp decline, falling to below 1 time by 2011, indicating underutilization of assets. After the merger, Sapurakencana Petroleum recorded a low fixed asset turnover, declining to around 0.67 times in 2014 before a slight recovery in 2015. This indicates that the merged company had a large asset base that was not fully utilized. Rather than improving productivity, the merger resulted in excess capacity and inefficient use of expensive assets. Moving on to the total asset turnover ratio, this ratio measures how efficiently the company used all of its assets to generate revenue. Before the merger, Sapurakencana Petroleum consistently recorded strong total asset turnover, close to 1 time, showing effective asset management. Kencana Petroleum, on the other hand, showed weaker and inconsistent performance. After the merger, Sapurakencana Petroleum's total asset turnover declined steadily from 0.61 times in 2012 to below 0.30 times in 2015. This trend shows that although the company's assets increased significantly after the merger, revenue did not grow at the same pace. As a result, overall operational efficiency deteriorates, indicating that the merger failed to enhance asset utilization.
Now, let us move on to the debt ratio, which measures the proportion of the company assets that are financed by debt. This ratio is important because it indicates the level of financial leverage and risk faced by the company. Before the merger, Kencana Petroleum maintained moderate debt ratio range from about 45% to 55%, suggesting a relatively balanced capital structure. In contrast, Sapurakencana Petroleum relied more heavily on debt, with that ratio consistently above 56% and reaching over 62% in some years. After the merger, Sapurakencana Petroleum's debt ratio remained high and increased to 65.13% in 2015. This shows that the merged company relied significantly on debt financing to support its expanded operation and asset base. So, the consistently high post-merger debt ratio indicates increase in financial risk. So when combined with declining operational efficiency, this high level of leverage exposes the company to greater vulnerability, especially during downturn in the oil and gas industry. Next is the time interest earned ratio, also known as the interest coverage ratio. This ratio measures the company's ability to meet its interest obligation using operating income. Before the merger, Kencana Petroleum demonstrated very strong interest coverage, with ratio existing 14 times in some years, indicating that it could comfortably meet its interest payment. Sapurakencana Petroleum also maintained healthy coverage, with ratio generally between 6 and 9 times. And after the merger, Sapurakencana Petroleum's interest coverage declined significantly from 9.47 times in 2012 to just above 3 times by 2015. This sharp decline indicates that interest expenses increased, operating income fell, or both. So, although the company was still able to cover its interest obligation, the reduced margin of safety suggests lower financial flexibility and a higher risk of financial distress if earnings continue to decline.
Next is market ratio. The first one is price earning ratio. This graph shows the price earning ratio trend for Kencana Petroleum and Sapurakencana. Kencana experienced some fluctuation between 2009 and 2011, while Sapurakencana showed a strong upward trend indicating a higher market confidence and growth expectation. After the merger and acquisitions, the price earning ratio increased significantly in 2012 and 2013, each showing a positive short-term market reaction. However, the sharp decline from 2014 to 2015, which suggests the weakening earning performance and reduced the investor confidence. Overall, the M&A had a positive short-term effect but negative impact in the long run. Second is dividend per share. This slide illustrates the dividend per share trend for Kencana Petroleum and Sapurakencana. Before the merger, both companies show inconsistent dividend payment, but Sapurakencana consistently record a higher DPS, reflecting a stronger profitability and greater ability to reward the shareholders. Following the M&A in 2012, the company paid relatively high dividends, indicating a positive short-term performance. However, no dividend were paid in 2013 and 2014 as management prioritized strengthening liquidity and covering the post-merger integration costs. By 2015, dividend payment resumed. It showed improved financial stability and renewed confidence in the company's earning capacity. Overall, although the dividends were temporarily suspended, the company demonstrated its ability to recover and continue rewarding investors in the long run. Last is dividend payout ratio. It showed the dividend payout ratio trend for Kencana Petroleum and Sapurakencana. Before the merger, Kencana's DPR fluctuated and declined sharply, while Sapurakencana maintained a higher DPR despite a downward trend, indicating a stronger profitability and dividend-paying ability. After the M&A in 2012, the DPR reached its highest level, showing a positive short-term impact. However, in 2013 and 2014, the DPR dropped to zero as the company focused on reinvestment and strengthening its financial position. By 2015, the DPR began to recover, indicating gradual improvement. Overall, the M&A had a positive effect initially, but resulted in unstable dividend payout ratio in the long term.